Good morning. Happy Saturday. My name is Lauren Anastasio. I'm coming to you live from Philadelphia with uncut hair and unmanicured nails, but otherwise super excited to be here. Very proud to be a part of this Money Moves Summit and excited to talk to all of you about ways to help improve your personal finances as you navigate entrepreneurship and also these uncertain times that we're having. There is a deck provided so that you can follow along with my presentation. But just as an introduction, I wanted to explain a little bit more about who SoFi is, who I am, and what I'm planning on covering today. So to start, SoFi is a personal finance company. We've been around since 2011, and I personally am a certified financial planner on our advice team. So I work with SoFi members, entrepreneurs included, to help them make wise money decisions. So we pride ourselves on helping our members get their money right. I'm here today to help you get your money right. And as peace of mind, I am a fiduciary. I'm here to provide you only the best advice. We never going to sell you anything. We're just here because we want you to be making wise financial decisions. So that's a little bit about SoFi, a little bit about me. As far as today's agenda goes, I am going to go through a presentation in regards to some of the best tips and advice we believe exists for entrepreneurs who are managing their own business and trying to manage various priorities, both personal and professional. I will talk a little bit about some of the unique things that we're seeing in regards to questions around personal finances during quarantine and how to navigate the pandemic. And then I do want to jump into as many questions as I can possibly address. I did get a number of questions in advance that you had all submitted. So I'm really excited about being able to address the specific questions that you have. So without further delay, I'm going to jump in. Please feel free to follow along with the presentation. So if you have the deck in front of you, I am going to jump ahead a little bit past the introductory material and jump right into managing cash flow with your personal finances. So one of the most common questions that we receive for entrepreneurs is, how important is it that I keep my business finances separate from my personal finances? And our recommendation is always going to be to try and keep them as independent as possible. So from a cash flow perspective, but also from a budget perspective, your life is going to be a lot simpler if you're treating you as you and your business as your business. So we do definitely recommend keeping a personal budget, keeping your business budget, and trying not to combine everything. I know it does take a little bit more time and thought to do everything twice, but the needs of you as an individual and the needs of your business are very different, and treating them as two separate entities will ensure that you're making all of the right decisions along the way. From a budget perspective, we recommend the 50-30-20 rule. So I am going to spend a little bit of time on this because this is a very common question for all members, including entrepreneurs. And the reason it's so important is simply because budgeting can become such an overwhelming and frustrating endeavor, but it's also vitally important to our businesses and our personal lives. So when we talk about the 50-30-20 rule, we're referring to the percentage of your income that we recommend you allocate towards your different expenses. 50 represents 50%. So 50% of your income should be going towards your fixed expenses. This is when we're talking about your personal expenses. 50% of your personal income going towards 50% of your fixed personal expenses. Think about these as your necessities or your needs. 50% of that income is going to ideally cover your mortgage or your rent, utilities, insurance, groceries, all of your essentials. Every bill that you have to pay is going to ideally be included in that 50%. The 30% is what we allocate for discretionary spending. So 30% can be used towards entertainment, travel, dining out, your new wardrobe. Any of your wants are going to be in this category. And then 20% is your savings. So at all times, we like you to be targeting at least 20% of your income to go towards savings. That's inclusive of retirement as well as your emergency fund. So one common question we receive, especially from those living in higher cost of living areas, like if you're in New York, if you're in the Bay Area, if you're in Seattle, DC, et cetera, it might not be realistic that 50% of your income covers your rent or your basic living expenses, and that's okay. We just want to make sure that if you do need a little bit more, that you're allocating that from your discretionary and reducing your discretionary spending. So maybe it looks a little bit more like 60-20-20 or 70-10-20, and that we're keeping that 20% savings as much as we possibly can. If you do have a higher cost of living, we just want to make sure that that 20% savings stays intact as much as possible. So that's a basic framework for how we recommend you manage your personal budget. It does become a bit trickier, understandably, for your business, but the reason that having that budget is so imperative is simply because it'll give you an idea of exactly how much you need to be able to pay yourself. So when you ask yourself as a business owner, how much should I be allocating towards my own pay? How much can I afford to pay myself? When you are able to look at your budget, you understand your necessities, you realize that saving is not an optional luxury, that's something that you really want to account for. You know exactly how much you should be paying yourself at a minimum in order to be able to make a comfortable living and keep more capital in your business. So if we move on to the next slide, past the personal budgeting recommendations, you're going to see a pretty simplistic graph, but what we want to represent here is the vital importance of saving and planning for your personal savings for times of kind of like inconsistent or choppy income from your business. So it's unreasonable to expect that any business, regardless of how successful it may be, is going to have a very consistent cash flow. So we want to make sure that we're allocating appropriately for that in terms of ensuring that there's enough capital on hand from a business perspective, and also that if your income from the business that you're paying yourself fluctuates over time, that you have the cash savings to tide you over as the business may receive kind of cyclical revenue. So of vital importance to try and maintain some cash and capital, both from a business perspective as well as a personal perspective. I'd like to So from here, I'd like to move on to some sort of foundational financial recommendations that we recommend for everyone, but the top foundational steps that we want to see all entrepreneurs or anyone who's self-employed, independent contractor, self-employment of any kind maintain. So when we look for building that foundation, so putting yourself in a comfortable financial place where you're able to manage any unexpected events, we want to see a few preliminary things happen. The first is establishing a safety net. So what we mean by this is cash savings, so maintaining liquidity, not necessarily a fully funded emergency fund, but I want you to think about it more as a cash cushion or a crisis fund that is available to you if you have an unexpected expense, but enables you to move on from saving up your cash to doing something like paying off your high interest debt. So step 2, beyond your crisis fund, which I would recommend about 1 month's worth of your essential expenses. So as you think about preparing your cash cushion, your crisis fund, think about all of the expenses that you have in 1 month and making sure that you have just enough in savings to cover all of those bills. Then we would want you to move on to addressing your high interest debt, whether it's credit cards, personal loans, unsecured lines of credit, essentially anything charging 7% interest or higher. We really want you to try and prioritize eliminating this debt as much as possible. The reason this is so vitally important is simply because any money that you save or invest will unrealistically earn or return greater than the cost of the interest you're accruing on that debt. Carrying that high interest rate debt can both be expensive and be damaging to your credit. So we do want to focus all possible energy on paying that down before moving on to the next step. Once you have your crisis fund and you've managed to eliminate any high interest rate debt that you're carrying, then we can move on to a fully funded emergency fund. Very common question is, how much do I really need an emergency fund? Is it 3 months worth of expenses? Is it 6 months worth of income? Is it really a year? And the answer is, it's really going to be dependent on you. So it's very personal. The amount that everyone would need is going to depend on a number of variables, which would include whether you're a member of a dual income household, are you a sole breadwinner, how many other people may you be supporting financially, are you a homeowner or not, and for all of you, very importantly, what's the consistency of your income? So for those who are self-employed, I usually tend to encourage them to go to the higher end of an emergency fund. I typically recommend somewhere between 3 to 6 months worth of your essential expenses. If you are self-employed, 6 months, possibly even up to a year, depending on how you where you feel comfortable, is going to make the most sense. So it doesn't strictly need to be only 6 months. It doesn't have to be as much as a year. You know your business, you know the cash flow circumstances that you have. Somewhere in that range is going to be what makes the most sense. But we do want to ensure that we have that saved and that it's being saved somewhere in cash where it's not taking any risk. We don't want it to be exposed to market risk of any kind. This is safe money that's there to protect you. This is an insurance policy. We don't want to be taking any risk with this at all. So those 3 items that that you see there: establishing a firm foundation, safety net, bad debt, emergency fund. So those 3 items that you see there: establishing a firm foundation, safety net, eliminating bad debt, emergency fund. These are the 3 things that we want to make sure are completely taken care of, ideally, before you move on to funneling money into your business. Okay. So on the next slide, in continuation of establishing a firm foundation, you'll find a little bit more detail and some of the subsequent steps that we recommend. This is what we refer to as our next best dollar framework. So when we talk about next best dollar, it's really, where is the next place or that my next dollar should go to? So what is the best place that each of my subsequent dollars should go? Once you have that safety net, for those who it would be relevant to obtain any employer match, what you see there, number 2, employer match, is representative of any employer-sponsored retirement plan. So if you do have access to one and there is a match available, we strongly encourage you to, at a minimum, contribute whatever you would need to maximize your match. We also want to ensure that you're protecting your income. So vitally important that you have appropriate insurance to cover you in the event that something happens, whether that's disability insurance, if you become injured and you're unable to work, or life insurance to ensure that if something happens to you, that your loved ones are taken care of what if you are to pass prematurely. Attacking bad debt, number 4, we talked about this a little bit already. We want to focus all of our energy on eliminating any high interest rate debt that we have. So even if it's 0% interest credit cards, any revolving debt, credit cards, personal loans, unsecured lines of credit, we want to make sure to pay those down as aggressively as possible and eliminate those before moving on to other things. We also look forward to having a fully funded emergency fund. So again, cash savings, anywhere between 3 months to 12 months worth of your essential expenses, depending on your personal circumstances and the cash flow of your business. And then we want to look towards being a little bit more mindful about the future. If you do have an employer match, that's great. If not, that's okay too. We do want to ensure, though, that we are thinking about the long term, that we're planning for the future, and trying to put aside at least 15% for the purposes of retirement. When we talk about 15%, we're talking about 15% of your gross household income for the year. I will talk in a little bit more detail further in the presentation about different avenues that you have as someone who's likely self-employed to be able to do that. But that is a step that we want to take before moving on to other financial goals. But once you get to step 7, it's really the world is your oyster. You get to decide exactly where you want to prioritize your money. You may want to funnel it all into your business. You may want to travel the world, go back to school, get married, start a family, whatever you want to do. This is the opportunity where you can do it. If you have steps 1 through 6 completed, go on to really funneling your cash flow into whatever's going to bring you joy. Marie Kondo would be super supportive of this one. So this is where things get a little bit more personal and you can make those choices. And only once you feel that you have satisfied all of your financial goals, at that point, do we recommend making any extra payments on your low interest debt. So low interest debt would include your mortgage, a car loan, student loans, anything that's on an installment and generally charging less than 7% interest. So if you are carrying that low interest rate debt and student loans and a mortgage or student loans and a car loan or any combination of those are the only debts that you have, feel free to put that at the bottom of your priority list. Feel free to focus on your business, focus on yourself, save for the future, as opposed to trying to aggressively paying those down further. Okay, so if we move forward, I know I mentioned I would touch more on saving for the future. And this does look a little bit different if you are saving for yourself or you don't have access to an employer-sponsored plan. There are a variety of savings vehicles available to you. A solo 401k, a SEP IRA are things that are going to be available specifically to those who are self-employed. For the purposes of today's conversation, I'm going to focus mostly on traditional and Roth IRAs as well as SEP IRAs. A traditional or Roth IRA are both individual retirement accounts that are available to anyone who has income. So you're able to contribute to one of these accounts as long as you have income. It's a personal contribution that you're making to a traditional or a Roth. And the difference between the two is simply in the tax treatment. A traditional IRA is made with pre-tax money or potentially tax-deductible money and grows on a tax-deferred basis where you pay taxes when you take the money out in retirement. And a Roth IRA has basically the reverse retirement or tax treatment, rather. A Roth IRA is where you contribute the funds on an after-tax basis and it grows tax-free. Then when you take the money out in retirement, you can take it out tax-free. A SEP IRA is designed to be something completely different. A SEP IRA is for those who are self-employed, and it is designed to be a substitute for an employer-sponsored plan. So as someone who wouldn't have access to a 401k or a 403b or some other type of deferred compensation plan, a SEP IRA allows you as a business owner to put funds into an IRA for yourself from the business. So this is an excellent way for you to save more for retirement and essentially to use those contributions as a business expense. So as always, I want everyone to try and work with a tax professional or an accountant in order to determine exactly what combination of accounts makes the most sense for you. But the great news is, as someone who's self-employed, you don't have to choose just one. You can have a combination of these accounts. So you can have a SEP IRA that your business is contributing to on your behalf. And you can also make your own contributions to max out at Roth IRA every year. So there are a variety of options available to you, in many cases, multiple options. We do want to ensure that you're using these as much as possible as you target that 15+% of your income for the purposes of retirement. That money being saved is going to be most effective in a tax efficient account like one of these IRAs. I'm going to skip ahead a little bit to saving and investing for the future. So this is just a representation of different buckets, if you will, to think about your money and what to do with money that you're saving for different purposes. All right, I'm going to skip ahead just a little bit. I want you to look at the slide that says saving and investing for the future. And when we say, saving and or investing for the future, we always want to start by thinking exactly about what goals we're saving for and what our time horizons are. So you'll see basically 3 different categories on this slide. And when we think about how we save and how we invest and where the best place is for our money, we want to make sure that those goals are falling into one of these 3 categories or one of these 3 buckets, if you will. So as I mentioned earlier, when you have an emergency fund, this is short-term money. We want to make sure that this money is not taking any risk. And that's going to be true for any balances in excess of your emergency fund that's earmarked for the short term. When we talk about short term, we're basically thinking about anything that's 3 years or less. So if that's, the desire to put a capital injection into your business, or maybe you're looking to put a down payment on a home in the next 2 years, anything that you want to use your savings for in that time period, we don't want to really be taking any risk. So we ideally want to see any money in that first bucket go towards a high yield savings account, even a CD if that makes sense, but it should be no risk money. Then we move on to our kind of midterm bucket. So this is something that you may have other financial goals that you're looking to accomplish. They're not necessarily long-term, but beyond 3 years. That's where we can look to begin investing. So we can have brokerage accounts. We can begin investing our money to get the benefit of capital market exposure. But we do want to be relatively conservative because we're not going to be invested for so long that we want to take a ton of risk. So a conservative allocation or an allocation that would be mostly towards bonds and fixed income would be most appropriate for this bucket of money for anything that's falling into that time horizon. And then lastly, we have our long-term money. So this is going to be anything, I would say, 7+ years out, usually 10+ years, something like retirement. We want to try and be a little bit more aggressive with these investments. So we have the peace of mind of knowing we're going to be invested for a long time, and that over a full market cycle, an aggressive allocation is going to be what gives us on average the highest annual rate of return. So this is going to be specifically for your qualified money. So anything that's in like a tax efficient account for retirement, whether it's those IRAs we talked about earlier or balances you have in prior employer 401ks. And we can also be aggressive with taxable money. So anything that's not in a retirement account, but is still earmarked for a time period of 7 years or longer. The following slide is included primarily to address the concerns around market timing. So right now we are experiencing not only a period of uncertainty with the economy, with the pandemic, with cash flow, with government intervention, but we see a lot of panic and we see a lot of fear coming out of all of the uncertainty, and a lot of investors who think they don't know what's going to happen in the market and they just would feel more comfortable moving to cash. The reality is, while it's tempting to try and take your money out of the market when you see the value going down, the important part of being invested is staying invested so that your money can be there on the days where the market improves the most. So this graph is basically demonstrating what happens if you remain fully invested over a 20-year period. So this is looking at money that would have been invested during that entire time period, and then how your returns massively decrease based on if you miss just a few of the best days in the market. So if you were to, let's say, look back at last month, right? So we saw a huge market correction in March, and the market was down about 30% year to date at one point. But we've also seen a rebound since then of over 20%. So what would have happened if you had sold out of your investments at the bottom and didn't remain invested just for those additional few weeks? Your losses would have been significantly greater, because now we're down year to date about 16% as opposed to 30% a month ago. So the important thing to remember is staying invested once you're invested is vitally important, because if you miss even just a few of the up days, the return on your money begins to drop significantly. So I'm happy to answer more questions about that at the end as they come up. But please, I know that things are uncertain, but we don't want to make emotional decisions when it comes to our investments. Okay, so moving on, just to recap the takeaways from the first part of the presentation, we want to make sure that as business owners, we are being thoughtful about keeping our personal and business finances separate. We want to make sure that we're treating ourselves like two different entities, and that we're being realistic with the budgets that we're establishing for ourselves. We do also want to make sure that we have a solid financial foundation by ensuring that we've eliminated our high interest rate debt, but also have saved for a rainy day. So we have not only our emergency fund, but enough cash to get us through less consistent times where we have second, we want to have made sure that we've developed a strong financial foundation. So this is going to mean having saved up an emergency fund to ensure that we're well prepared from a cash perspective to navigate times of inconsistent income or any unexpected expense. And then we've also eliminated our high interest rate debt, that very expensive debt that makes it difficult for us to allocate cash resources to other things. We do want to ensure that we're saving and investing for the future. So putting aside ideally that 15% for retirement, 15% plus, we're leveraging those tax efficient accounts that we talked about. So that Roth IRA or traditional IRA, a SEP IRA, 401ks, if you have access to it, any tax efficient account that's going to allow you to have your money compound more, whether it's tax deferred or growing tax free. And we want to ensure that all of the allocations or the investment selections that we have within those accounts are appropriate too. So this means that we're not being invested too conservatively in our long-term accounts, and we're not taking too much risk in our short-term accounts. Remember those three buckets: short-term, middle-term, long-term. Anything in the next 3 years, no risk, keep it in cash. Anything about like 4 to 7 years, we can invest, but be a little bit more on the conservative side. And then kind of like 8 years out, we can be more aggressive. And for most of us, that's going to mean any money that's in our retirement accounts should be invested aggressively to ensure that those accounts work most efficiently for us moving into the future. And then last, we really want to ensure that we are incorporating other professionals into our kind of like personal board of directors, right? So whether that means talking to a financial planner to make wiser decisions, getting an attorney involved, or having an accountant. So another really common question I receive is, is it worth it for me to hire an accountant? The answer is usually going to be yes. Many people think of an accountant or a tax advisor as someone who just prepares your taxes once a year, and that's not necessarily a service everyone wants to pay for. But the reality is, this is a tax professional who is like an abundant resource of great advice. So that's a person that you want to rely on throughout the year to make sure that you're making really wise and strategic decisions, not just someone that you're going to call on to help you summarize what happened in order to report it to the IRS. So those are the kind of general takeaways that I wanted everyone to have for the first segment of this presentation, which is just to summarize that on a consistent basis, whether we have this conversation in the middle of a pandemic or we're having this conversation 3 years from now when things are totally different, all of these fundamental pieces of advice are going to hold true. So this is information that is consistently true every day of our lives. I do want to take the time now, though, to talk a little bit more about some more timely issues and common questions that we've been seeing during our kind of experience with COVID-19. And so I want to address a couple of common themes that I've been seeing with members and things that I think would be really helpful for you as well. Okay, so for those of you who are ready to move on with me, I wanted to kind of touch on these 3 themes that I've been seeing most often over the past month or so, or basically since coronavirus really began to impact the economy and our lives. The first in regards to student loans and the impact of the CARES Act on any federal student loan debt. I have many people asking questions about what this means basically for their student loans, and is this something that people should be taking advantage of even if they can still afford to make their student loan payments. So for those of you who are unaware, the CARES Act has created a waiver on student loan interest as well as payments on federal student loan debt through September 30th. So this means that if you have federal student loans, that they're not accruing interest during this time, and your payments are optional through the end of September. So even members and friends that I speak with who are in strong financial positions, the way that I see it, the way that we are advising members at SoFi, is that you basically have a guarantee here. There's no interest accruing on this debt, and the ability to make payments is optional. While we may not have incurred a loss of income or job loss or some other financial hardship yet, for the potential of any uncertainty over the next few months, if you think that there's any chance that you're going to have some type of income disruption or any other unexpected expenses, it makes sense to reallocate what you would be putting towards those payments and putting them aside. So if you do have federal student loan debt, and right now they're accruing 0% interest and the payments are optional, I highly recommend putting that money aside and saving it until October. So whether you decide that you're going to take that money and use it towards other financial goals, like build up your emergency fund, or you're going to instead reallocate that towards your credit card debt, those are excellent things to do with that money instead of making a payment on a student loan that's at 0% interest that doesn't require a payment right now. Alternatively, if you have a fully funded emergency fund, if you don't have any high interest rate debt, if you are saving for retirement, and there's not any other obvious place for this money to go, I still recommend putting the equivalent of the payment aside each month through the end of September. And then if you're lucky enough that you don't experience any financial hardship or loss of income between now and October 1st, you can simply go ahead and make a large lump sum payment at that time. And it would be exactly the same end result as if you had been making those regular payments each month over the summer. But you instead have the opportunity now to take advantage of that 0% and potentially build up a cash cushion to help prevent you from any additional uncertainty that we may see through October 1st. The next topic that I'm seeing very frequently are questions about refinancing. So whether that's refinancing a mortgage, refinancing a car, refinancing student loans, or even consolidating or restructuring credit card debt. We did see the Fed lower interest rates in reaction to what was happening with the economy, and interest rates are in fact at record lows at the federal level. We haven't necessarily seen that trickle down to all consumer debt, but what we do know is that now could be a good time to explore options to restructure your debt. So if you are a homeowner, it's worth asking around and seeing what mortgage refinance rates look like. If you have credit card debt, it's worth seeing if you can consolidate that onto a personal loan, or call your credit card companies and just ask them if they're able to give you a lower interest rate. I tell people this all the time. Credit card company is never going to give you anything without you asking, but they are prepared to lower your interest rate, even if you're not having a financial hardship. This is something that you can always ask for. They might say no, they might not be able to do it, but it's absolutely worth the 2-minute phone call to your credit card issuer to find out if it's an option. Same goes for private student loans as well as vehicles. So make sure that if you do look into refinancing, you're considering any upfront or out-of-pocket costs and rolling that in. If you go to potentially ask for a mortgage refinance, make sure you ask the lender if they can provide you with a break-even analysis. This is going to be something that helps you determine, okay, if the rate is lower, how long do I need to stay in this house in order to recuperate the closing costs? Because there will be costs to refinance your home, and you want to make sure that you're saving enough on interest to actually save money net of those closing costs. Private student loans, as I mentioned, always worth looking into that. There is no cost to refinance your private student loans. I don't recommend touching those federal loans today because you have that 0% through September 30th. But if you do have private student loan debt, always worth looking to see if you can get a lower interest rate. This is going to be your debt that you just pay the minimum on, and you're focusing on other things. If you can get yourself a lower rate, you're just guaranteeing yourself savings. And then the last of kind of like the 3 common themes that I'm seeing from many of our members is in regards to investing. So many people are wondering, is now a time for me to stop contributing to my retirement? Things are really unpredictable. Should I turn my IRA contributions off? Should I be taking money out of the market? And on the flip side, people coming to me saying, I hear now's a really good time to be invested. I've never invested before, but I'm thinking about taking out a $20,000 loan and putting it all in airline stocks, for example. I don't recommend doing any of those things. So we are going through an uncertain time, that's true, but the reality is most of our investments are invested for the long term, and that's what makes sense. And we account for times like this when we think about the expectations of our returns for highly risky, highly aggressive, volatile portfolios. No one was able to predict COVID-19. No one was able to predict what coronavirus was going to do to us. But what we were able to predict was that we were going to see some sort of market correction. And everyone is kind of operating under the assumption that this is an unprecedented time and that we've never seen something like this before. And while that's true, we've never lived through a pandemic. We've never seen something like this. We've never been quarantined this way. And we haven't seen it in this fashion. When it comes to the economic side of it, when it comes to strictly capital markets, we have seen this before. I'm an 80s baby. I was born in 84. And I went back and I looked and I said, okay, I know that this is not the first time that this has happened in my lifetime. I was probably too young to remember it. And this has actually happened 5 times during my life before this year. So it happened in the 80s, it happened in the 90s, it happened in the early 2000s, and it happened, as many of us remember, it happened in 2007, 2008 with the Great Recession. So I know that it feels like we've never lived through anything like this before, but when it comes to our money, when it comes to finances, capital markets, the economy, we have lived through things like this before. We were just too young to remember what it felt like. And the great news is that um, we'll withstand the storm this time around. And chances are, when we see the next recession, when we see the next correction, which we'll probably see 5 or 6 or 7 or more of them through our lifetimes, we'll feel far more comfortable and confident about moving forward without making emotional or rash financial or investment decisions. Okay, so I'm really excited to get into the question and answer portion. I had a lot of questions come in from the folks that Create and Cultivate on your behalf. I did want to highlight a few things first, just in case we run out of time. For those of you who, again, who are not familiar with SoFi, please visit SoFi.com to get more information. We do have a partnership with Lantern. For those of you who are interested in small business loans or looking for any assistance applying for paycheck protection. Okay, so super excited to get into the Q&A session. I have a lot of great questions that were provided on your behalf by Create and Cultivate that I'm looking forward to getting into. But before I jump into that, just in case we run out of time, I did want to highlight a couple of things that SoFi is offering. So first, if you're not familiar with SoFi, please feel free to visit SoFi.com for more information. As small business owners, I did want to let you all know that we partner with an organization called Lantern. So for those of you who are interested in small business loans or for assistance with the payment protection program, Lantern is going to be a great resource for you. So please feel free to visit SoFi. Look for small business loans on our website. You'll be directed towards our partner Lantern, and there are going to be a lot of great resources for you and your business there. The second is that as a part of our partnership with Create and Cultivate, we do want to offer all attendees today a complimentary session with a certified financial planner like myself. So for peace of mind, we are all fiduciaries. We are not here to sell you anything. We're simply here for the purposes of objective advice and education. So if you'd be interested in speaking with me or one of my colleagues for a one-on-one consultation, just to go over any questions that you have about personal finances, any topic is on the table, please feel free to visit the website on the last page of your slide deck. For those of you who don't have it in front of you, it's sofi.com/sofinancial, SoFincial. And you're welcome to schedule an appointment. Typically, we're booking up about a week in advance, but we're happy to provide this to you as attendees today. And we want you to feel like you have personalized resources available to give you custom advice. And as a note, SoFi does also offer career coaching. So we do partner with Korn Ferry. This is a benefit that's available to our members. So for anyone who's looking for expert career or employment advice, we have resources available for you there as well. So just wanted to make sure that I touched on these things. I didn't forget these are benefits that we wanted to offer to participants today. But with that, I'm going to start jumping into the Q&A. If there's a burning question that you have that I just don't have the opportunity to get to, please feel free to schedule time with me at that link on the last page of your slide deck, and I'd be happy to address any additional questions that you have in a one-on-one session. Okay, so one of the first questions I received was about cash flow. And the question is, how often should I be managing my cash flow? Should it be weekly, monthly, or quarterly? And the answer is really, it's going to be very personal. So it's highly dependent on you and your business. Some organizations, some businesses, it doesn't make sense to do it too frequently because you may see more seasonal or cyclical behavior in your expenses and your cash flow. It is important to stay on top of your business finances as well as your personal finances. I don't think that there's such a thing as looking at it too often. But if you're thinking about what period makes sense to really evaluate your cash flow, it is going to be heavily dependent on your business. But I recommend trying to align any expenses that you can with seasonal or cyclical inflows from your business. So if you have a pretty consistent revenue stream or pretty consistent cash flow, then allocating things like insurance and overhead expenses and that frequency makes sense too. If you have a business where maybe there are 2 times a year where you have a high influx of activity and revenue, trying to pay things like your insurance or other expenses on a semi-annual basis would make sense. So there's no universally right or wrong answer. It's going to be heavily dependent on your business, but the good news is there's no wrong way to do it. The next question is about hiring an accountant. What experts or tools should I invest in early on to avoid any financial mistakes later on? And this goes back to what I had mentioned about creating your own personal board of directors. It is going to be hugely beneficial to you to have a cabinet of kind of experts available to you to help you make decisions. Hiring an accountant, again, does not mean that you need to pay someone to prepare your taxes. It simply means that there's going to be someone who understands you, that understands your business and the financial implications of both. And that person is there for you as a resource. So if you are enlisting the help of a tax advisor, of an attorney, of an accountant, make sure that you actually take advantage of them and you're asking them questions along the way so that they can make recommendations, not just tell you when you had a missed opportunity. But there's no one I would not recommend hiring an accountant. Next question, how can I be strategic in my spending and ensure I always have positive cash flow? So the reality is there's not going to be a scenario where you always have positive cash flow. Maybe you have a very unique business where that is possible, but for most businesses, even like large corporations, it's very rare that cash flow will always be positive. And that's why maintaining capital and on a personal level, having an emergency fund is so vitally important. The more important part here about being strategic in your spending is really a matter of being disciplined in your spending. So trying to make sure that you're cutting any unnecessary expenses when the cash flow is a little bit tighter to try and keep any negative cash flow to a minimum and bring you back to a time where you're bringing more cash into the business. So it's really more a matter of diligence in your spending, making sure that you're shopping around for your services and lowering costs wherever possible. But it's okay if your cash flow isn't always positive, as long as you're prepared to get through however long a cycle is to bring you back to when cash flow is positive. Next question. My income doesn't leave much room for savings, but I really want to start. How can I save money on a tight budget? This is always going to be tricky, but my answer to everyone, regardless of how tight their cash flow might be, is make sure that you're paying yourself first. So you always want to make sure that you're paying attention to that 50-30-20 rule, right? No matter how our expenses change, we want to prioritize that 20% for savings as much as we possibly can. If you're not there yet, if you're at a place where you're addressing debt and you can't quite save 20%, that's okay. But whatever you are able to save, that is what goes first. So each time you pay yourself, money goes directly into the savings account and you use whatever is left over for your expenses, not the other way around. If we wait until the end of the month or the end of the pay period to save whatever's left over, you're going to save significantly less than if you set an amount, allocate it up front to go into savings, and then only allow yourself to spend what's left over. Next question. What are some simple and fast ways to curb spending and save money while dealing with this global crisis and quarantine period? So that's a loaded one. There are a lot of things that we can be doing right now. One of the first things I recommend is calling everyone. So call your credit card companies, call your bank, call all your servicers, your utility companies, and ask them, what do you have available to me? What payment modification options are available? Are you able to lower my interest rate? Are you able to lower my costs in general? So auto insurance is a perfect example. Right now, a lot of insurance companies are looking towards providing refunds to their clients and their customers, because the reality is people aren't on the road as much. So these are costs that we easily overlook. We know we have to pay for insurance. In many cases, people only shop for insurance once every few years, if not longer. But that's a really easy way to save some money. Call your insurance company, let them know, I'm not hosting as many events right now. I'm not, working with as many clients right now. I'm not on the road as much. And see if there are reduced rates that they can offer you. Any debts that you have, whether it's your mortgage or credit card, or even if it's your cable bill, call them, ask them, what's available to us right now? What are you willing to do, to help me out as a loyal customer? So calling everyone that you already are giving money to and seeing how they can help you reduce your expenses is going to be some low-hanging fruit. They're easy phone calls. These companies are prepared to help you and everyone else that they serve right now. And it could be one of the easier ways to reduce expenses rather than looking for costs that you're able to eliminate altogether. In terms of spending, if you find that spending is an issue for you, or you don't trust yourself because being at home hasn't reduced your discretionary spending as much as you had anticipated, because DoorDash is easily available and Amazon's still selling everything that they can, then another way to curb spending, if you found that you're not your discretionary spending hasn't been decreased as much as you had thought, being quarantined or sheltered in place, is to stop using your credit cards. So many of us may have found that even though we're not going out as much, that online shopping and ordering delivery is still a pretty significant expense, and we're all probably spending a little bit more at the grocery store than we're used to. But the reality is, if that alone isn't helping us decrease our discretionary spending, one of the easiest ways to do it is to switch to a different method of payment. So if you stop using your credit cards, try and switch to cash, using your debit cards only. We will automatically find ourselves spending less money. So many studies have been done, found that people who do use debit cards or cash at the store tend to spend about 10% less than those who use a credit card. But it's also a good way to help us manage our budget. So some people like the envelope approach, where you allocate so many dollars towards groceries, towards entertainment, towards any other expenses, and you put them in different envelopes for the week or for the month. And once you've spent all of the money in that envelope, you don't spend any more money on that item. So those are some recommendations for while we're home, but I do highly recommend, please start calling everyone that you pay money to and seeing if they can lower your rates, lower your interest, and help you lower payments for things that you're going to be continuing to pay for on an ongoing basis. Okay, moving on. Next question. What should we do if cash flow is tight right now? Is it smart to turn to credit cards? So I know how tempting that is, but I would try to avoid credit cards as much as possible. So again, please feel free to visit Lantern, looking for small business loans or any help with the payment Paycheck Protection Program. So any resources, whether it's like your local small business association or other lenders where you're able to acquire loans or grants or even lines of credit, are all going to be safer for your credit and less costly than borrowing with your credit card. If you cannot avoid your credit card at all costs, you've exhausted all other options, there are 0% offers that often exist. I would shop around, check to see where you can get the longest period for a 0% offer, and try to just use it as judiciously as possible. If you have an existing credit card, call your credit card company, see if they have any type of like flex loan option. I know both Citibank and American Express have these, where you can use your credit card, but they treat your charges like you're putting them on an installment loan, which is healthier for your credit, and it will also be less costly. So I would try to avoid your credit cards if possible. If not possible, please shop around. Make sure you're asking your credit card issuers the right questions before just putting charges on them, because there's still likely ways that you can use those cards, but keep your costs down. Next question. I'm interested in investing. Is $1,000 enough to start? Where do I invest? How do I learn? Oh gosh, such a great question. Such a great, like 4 questions. All right, I'm gonna tackle these one at a time. I'm interested in investing. Is $1,000 enough to start? Absolutely. I don't think that there's any amount too small. We do want to make sure that we're being cognizant of where we are in our financial journey. So when it comes to that next best dollar framework, please feel free to go back and reference that from the deck. But if you have accomplished establishing your emergency fund, you have paid off all of your higher interest rate debt, you have the appropriate insurance, and you're saving for retirement and you're ready to invest, I don't care if it's $1,000, $100,000, or $10. That is absolutely enough to begin investing. There's no amount too small, in my opinion. You absolutely do not need to wait until you've saved up a lump sum to begin getting invested in the market. As far as where do you go to invest, there are a lot of companies out there that are available to novice investors. SoFi is absolutely one of them. So we do have 2 different types of investment accounts on our platform. The first is a self-directed option, which is where you're in the driver's seat. You can pick and choose your own investments and place your own trades. The other is a managed account, which is also a very common selection that people are interested in, where you simply put in the cash and SoFi invests on your behalf. Both of these are completely free of cost. SoFi does not charge any commissions or fees on these accounts. So the barrier to entry for you is very low. You have the peace of mind of knowing that you can be invested and invest as little as $10 without there being a cost associated with it. Especially when it comes to like individual stock investing, a lot of people feel like they don't really know that it's worth it if they can't buy a whole share. So for example, Amazon trades around $2,000 a share, and someone might think it's not worth it if they can't buy at least $2,000 worth. Well, SoFi has really eliminated that barrier, and we allow you to buy fractional shares, or what we call stock bits. So if you have that $1,000 and you really want to invest it, and you want to invest it in a few different companies, you can buy $500 worth of Amazon or $25 worth of Amazon, even though it trades at $2,000. So again, there are plenty of options out there for you. SoFi offers 2 investment accounts at absolutely no cost, and one of them will allow you to invest without any type of minimum or without the expectation that you would need to invest in whole shares to make your investment worthwhile. And then the last question there is, how do I learn? And that's a really great question. There are plenty of resources out there. There are a lot of blogs, a lot of websites, a lot of podcasts. The reality is in many cases, it's going to be trial by fire. And one of the most effective ways to learn is by doing. I really encourage you to schedule an appointment with a financial planner at SoFi. Again, this is going to be a complimentary conversation, no expectation that we're going to sell you anything, but we're able to answer questions that you have and kind of guide you through the basics of investing. And it gives you the opportunity to ask questions without feeling like a website has paid advertisements to sell you something, or that the advice isn't appropriate because it's for a much broader audience. So there are resources. I do recommend, if you are using websites or blogs or podcasts, just try to find ones that are objective and aren't necessarily providing like individual stock tips, because I would be very wary of any publication or resource that's doing that. But please also, again, feel free to schedule an appointment with a fiduciary like myself at SoFi in order to kind of address some of your questions and get the education that you're looking for. And I don't know that we have a lot of time left. I will try to get to one last question. What is the difference between short and long-term investments, and should I consider both or choose one? So going back to what we talked about earlier in regards to buckets, the short-term versus long-term investments are really going to be differentiated by the type of investments that you hold. Shorter-term investments, we recommend more conservative investments like fixed income funds and bonds. Longer-term investments, we recommend things that are a little bit more aggressive, more volatile, like stocks, and equity ETFs or mutual funds. The difference is really how long you plan on being invested. If you're a shorter term investor, or looking for your midterm money, anything 7 years, basically 4 to 7 years, the bonds and the fixed income, more conservative investments make sense. If you're investing for the long term, stocks and more aggressive investments make sense. If you're saving for multiple things, which is very possible, like you're saving up for a down payment on a home, but you're also saving for retirement, then both make sense. Aggressive in your retirement accounts, more conservative for your home buying fund. So the answer is going to be, it really depends on what you're saving for, but it absolutely can make sense to have both. And you want to make sure that the investments that you're choosing align with your time horizon. So I think we're completely out of time. I don't know how that hour went so fast. I had a blast. I hope all of you did too. Please, if you'd like to continue the conversation, I would love to hear from you. Visit SoFi.com/SoFinancial. Find me, schedule an appointment. I'd be happy to chat further about any of the topics discussed today. But I hope you all have an awesome rest of your day. Enjoy the Saturday. Enjoy the rest of the speakers. And best of luck. This has been a total blast for me. Take care. All right, one more question. I'm just trying to be cognizant of time. I have a lot of credit card debt. What advice do you have for getting this down and fixing my bad credit? Okay, so the good thing is usually those two go hand in hand. So as you tackle paying your credit card debt down, you usually will see your credit score go up. A couple of ways that you can do this. One is for looking at consolidation options. So that might be a personal loan. If you're a homeowner, you may look at a home equity line of credit. If you have an employer-sponsored plan, like a 401k, you might look at a 401k loan. These are options to consolidate your credit cards onto a different type of debt at a lower interest rate, which can help you pay it off sooner. If those aren't options available to you or just aren't as appealing, I do recommend choosing one strategy to pay down your credit cards. Which strategy you choose is up to you. So there are two very common strategies that are known in the universe for paying down debt. The first is what's known as the avalanche approach, where you prioritize your different credit cards by interest rate, highest to lowest. The other is what's known as the snowball approach, where you prioritize each of your debts or your credit cards from the lowest balance to the highest balance. Whichever one you choose, the one thing that those two methods have in common is that you only pay the minimum payment on all of your other debts, and that one card that you're prioritizing first gets all of your extra money. So in each scenario, you're targeting one card and trying to pay it off in full as quickly as possible, and then moving on to the next. If they both kind of sound interesting to you and you're not sure which one to choose, I personally recommend the snowball approach. I feel people have more success with it. They tend to pay cards off much quicker. And if you have like 5 different cards that have balances on them, you can reduce that very quickly down to 4 or 3 or 2, and it becomes far easier to manage. Um, but remember, in the meantime, definitely call all of your credit card issuers, see if you can negotiate down your interest rate. They may offer you like waived interest for a short period of time. There are a lot of payment modifications out there right now because of what's going on with the pandemic and unemployment. So don't be shy. Absolutely call your credit card companies, ask them what they have available to you. And at the very least, just start saving interest wherever possible. Okay, next question.